going into this part, because I know you were saying a little bit about confirmations, confluences. So, what is your strategy? And you know what's, I'm laughing because I feel like every time I do a podcast, I always talk about strategy. Everybody just wants to hear that part. It's like they think that's the holy grail of becoming a successful trader in their eyes. But just realistically, what is your strategy, and is it more than one strategy you follow, more rules you follow, and how I guess you found the strategy and how you built the strategy is kind of my question.
Well, that's interesting because as I knew that was gonna pretty soon get hit with that question.
Well, we talked previously about it too, and I remember you introduced me to something. I was like, "What are you talking about?" So
Yeah.
yeah, I'm interested to hear this too.
So I mean, I'm gonna kind of revert back to when I was talking about right around the time I ended with options and things like that. I started to kind of see, around the social media world and stuff like that, maybe YouTube and things like that. I started to, hear about, and I ran across ICT strategies. So, and this is a particular individual who was saying that the markets move algorithmically and they're manipulated. And in that regard, it's not all what people consider to be like buying pressure, selling pressure, things of that nature, but that there is a algorithm that's actually in play, and price moves algorithmically to whether whatever price targets and things like that are going to be that are looking to be made. Ultimately, it comes back down to when you're looking in the market, either the market is searching for inefficiencies or it's searching for liquidity. So coming along with that, I think on him, he was at that time he was actually like posting YouTube, and he had a mentorship that I guess he put online and everything like that. So actually, with that, I was at that point in time still, using, the good old fashioned, a lot of all of the tools and things like that. We know RSI, you think about Fibonacci, you think about, your MACDs, everything. Of course, you think about all of your different type of chart patterns and things like that. Your trend lines, everything. So one thing for me, because I'm quantitative, so I'm in that realm. I'm a person that I'm always trying to figure out why. I want to know why. I want to know how. And then I also decided that for trading, I always wanted to know I need to be as close to price action, real time price action, as possible, and being able to read right off of real time. And because with a lot of the tools, the typical trading tools that you're using, all of that, a lot of those are reactionary. So it needs a history of information before it can actually provide you something. So now you're dealing with a delay and a latency of information that you're getting. And I want to get as real time as possible so that as real time I can react when the market's reacting and then have an idea of understanding of what's going on with the market. So as I started to, I found that ICT and I started to go ahead and, take an interest in it. And then I kind of went through all the videos in his mentorship. It was like a 2022 mentorship. And that's where we kind of came off. And then I was talking to you about that as I was kind of going through it. And I started to now look at and implement some of those things. And with that, it was then that's where I was going ahead and starting to use a little bit and devise a strategy regarding understanding the algorithmic price movement, and understanding like all of the particular attributes of the things in which he incorporates, the lingo which he uses, FEGs, understanding imbalances, understanding all of the things that the market leaves, because what he says is that the market always leaves kind of like hints at inefficiencies that ultimately later are going to be reclaimed. And when you're seeing that, now you're starting to talk about things that are a little bit more mechanical or methodical. It means that there is something that is basically controlling the market and how price moves. Now, there are things, of course, that are unknown and all that as well, but you're also now looking at with these hints in the market and these imbalances, that means when you're understanding price action, you're understanding the bidding aspects of, buying pressure needs to be met with sell pressure because it's an auction. Okay, so if you have an inefficiencies of buying that's happening and it creates an FEG, that means there creates a void of meaningful sales that can actually match those buyings. That means at a point in time, those are going to have to come back and be reclaimed. And then it's understanding like the principle of how some of these things are moving throughout the day, and understanding basically how price is moving at that particular time, and then your anticipation of what's possibly going to happen then in the future.
So would you say you seen a dramatic change after you learned, I guess, from ICT and kind of seen a different point of view?
Yeah, that kind of helped in regards to kind of getting a little bit more of some real time understanding of price action, because like I said, I wanted it as real time as possible. So now understanding that, it's kind of like, okay, well, let's understand a little bit more. So at that point in time, he was still dropping videos and things like that. So it was kind of learning as things were getting dropped. And as, continuously he was giving more and more information in regards to understanding aspects of price, understanding how big banks are usually looking to maybe buy at that point in time, and how, and maybe even like what time frame, like a majority of like big money moves, which is like everything over 4 hours. So 4 hours on the daily, weekly, monthly. Like those are the major levels in which bank money moves. So now when you think about that, okay, you can look at higher time frames as though they have more validity to them in regards to where you're looking at potential price going for, let's say, the trading session, or for like the span of a week. So if you're looking at, let's say, a new week, you can do maybe like a weekly analysis. Okay, well, let's look at on the daily what's going on, and let's see like, okay, well, where are the inefficiencies that are happening on the daily? Where is liquidity at? Because once again, it goes back to, its price is either searching for two things. It's either searching for imbalances or it's searching for liquidity. Basically, swing lows, swing highs, or gaps and imbalances. So that can give you a little bit of a bias now in regards to the weekly, in regards to where you're expecting for the week, maybe price is going to go. And now, with that being the case, he also then started to provide, gems about other back end things that, maybe like people didn't know as much in regards to kind of like, what are, you know, um, quarterly shifts in the market and things of that nature. So some things he used to kind of hint at, and he has a lot of like talking that's like, a lot of fluff and stuff like that as well, while he kind of like hides certain gems within like certain aspects of his conversation, as well as in regards to his uh, the things in which he's talking about and the strategies and all of that. So I would say like that kind of moved my focus more towards that particular strategy, like smart money concepts, and that kind of helped me with, devising a little bit more of a different type of strategy in regards to like learning that, and learning in regards to how those prices move and all of that. Now I've been kind of like hit or miss and up and down in regards to those strategies and getting something consistent, because for me, I'm a person that's like, I want to know everything. I remember I told you this like a while ago. I was like, I need to understand like every aspect of kind of like what's happening in the market, and what is going to be kind of like that aha for me, and it's going to be that moment of clarity where you're kind of like, okay, a lot more things are opened up, a lot more things are now understood in regards to, okay, I've now better understand price action even more so than what I did like maybe a year, 2 years ago.
Yeah.
And that kind of ties into something that I just come across probably maybe about 3 months ago in regards to quarterly theory.
Mm.
And quarterly theory is because I love math. Now it breaks things down into like even more like mathematically, um, things, and everything ties into the everything moves in the power. Everything moves in the way of four. So 4 quarters, 4 sessions, four technically 4 trading days. So of the week. So this comes from Trader Day, who actually came upon this. And these are people who've kind of like expounded more off of initially ICTs and his concepts. Also understanding macros, because now when we're talking about algorithmically how price may move, there are certain macros and algorithms that run at certain times of the day, which is a price run. And at that point in time, price is making a run towards either liquidity or into an imbalance. And these macros happen multiple times throughout the day. So then ICT also used to hint at the time windows for when those macros run. So that then kind of leads you to go back into the charts to say, okay, well, let me actually like look at that to understand, you know, and these are 20-minute macros that run. So
20-minute macros.
correct. And there's 2 macros every hour. So there's, you know, the 20-minute to the 40-minute, and then there's the 50-minute to the next hour 10-minute block.
Wow, very, very detailed. Quarterly theory, right?
Mm-hmm.
And is this what you're specializing? Well, I don't even say specializing, but is this pretty much like your strategy that you focus on?
As I started to kind of run into quarterly theory, opened my eyes up to more stuff about seeing a little bit more of a blueprint on how the market is moving. So you pretty sure are well versed in, of course, accumulation, you know, manipulation, distribution, and you know, continuance and all of that. So everything works off of AMD, which is the power of 3. So in that regard, that's kind of the things in which ICT also kind of used to talk about.
Okay.
So now to play off of that, understanding that quarterly theory, when you're starting to understand certain hints at what's going on in the market, understanding a true day open. When does the actual market open truly? At noon. I mean, not noon, sorry about that, but at midnight. So that true day open price more than likely probably isolates between the true day open above and below it. So now understanding that, you also have now your sessions that exist. So think about it like this: when everything moves in a quarter of 3, think about it. There's 4 seasons in a year. So with that being the case, that kind of hints back to what ICT talked about in regards to quarterly shifts in the market. And each quarter, there's a shift in sentiment. And in that sentiment shift, you then start to see price action now basically change and start to go, maybe you may start to go from selling power to now buying power in those quarterly shifts. So, okay, so if that is the case, and you're maybe starting to even see those correlations, gotcha, power 4 quarters basically. So you also have now what you consider to be, have you ever heard of 90-minute sessions, 90-minute cycles?
Break that down.
So within each session, when you think about, let's say, within the trading day, you have what, 4 trading basically periods and sessions. So you have Tokyo, then you have London, then you have New York, AM, then you also have the PM session. So now when you think about Asian session is usually what? It's about 6 hours, 6-hour session. London is another 6-hour session. New York is another 6-hour session. And then I think there's so then that's 20, I mean, that's 18 minutes, 18 hours.
18 hours, yeah.
Then there's I think one last, which is, then there's another last that leaves 6 hours that's left.
Sydney,
Sydney.
right? Yeah, Sydney.
So that takes up a 24-hour span. So 6-hour sessions, 4 quarters. In regards to that, you can now break those 4 quarters down, take 6 hours, divide that by 4, 90-minute sessions. So you got 4 sessions in each, basically 4 quarters in each session of a trading day. So within London, in first quarter is seen as it's not a time to trade. Basically, price is getting set, a range, a dealing range is getting set. Quarter 2, 3, and 4 account for accumulation, manipulation, and distribution. Power 3. So in that regard, the first session you should be looking at is when you're going to see a manipulation in the market. Opposite direction also could be known as your Judas swing. Then from there, you're going to then see usually right around by quarter 3. Quarter 3 is usually the optimal time to trade and to get in a trade. And in that regard, you can then kind of see the distribution, because that's where you also get a good amount of the volume and distributes out. And then from there, depending on usually the time of day, depending on what the market is going to do, you can then get a continuance of that distribution for further expansion, or you'll get a reversal for kind of like a small retraction back into, a little bit of the range of how it distributed. So those are the kind of the things that tie into like how I now look at the market. Those things are basically complementary to ICT strategies and everything as well. So with that being the case, now when you look at the trading week is technically what? It's 5 days, but Friday is not considered an actual trading day. So that's quarter of power. That's 4 quarters again. You got Monday, Tuesday, Wednesday, and Thursday. Monday's always said it's not the optimal day to trade. The beginning of the week, you let price determine the range that it's going to trade within or trade out of. So then you have Tuesday, which usually they always say Tuesday is going to primarily be where it's going to run into maybe your high or low of the week for that candle. And then you have Wednesday and Thursday, the most optimal days to trade, and where you're going to get the most the price movement. And then once again, use that same principle in regards to how you look at those markets, and it's fractal. Markets are fractal. You can break up.
You see on one time frame, you see on another.
Exactly. So with that being the case, use the quarter theory in regards to now break those sessions down from 90-minute cycles by 4. So now you can basically do the same exact thing within that 90-minute cycle to 4 22.5-minute sessions. And you can still look for the exact same movement in regards to a first dealer's range being set, then manipulation, then distribution, then whether it's going to be a continuation or reversal.
That is a very nice way to break that down. I learned a lot.
Yeah.
For sure.
And that's kind of like the thing where I'm at now in regards to like, I build upon like going through ICT, I've built upon like the strategies and understanding that, as well as when I started to come across quarter theory, that actually helped to kind of like open up some more things in regards to understanding of, let's say, price and algorithmic price movement at that particular time, and at whatever particular time that you're looking to trade. Basically, quarter 3 is the most optimal time period to trade. So if you look at quarter 3 and all different time frame references that you're doing, you want to trade on the quarter 3 of the daily, quarter 3 of like your micros. Your micros are kind of be any time frame that's basically under what you consider to be like your 90-minute cycles.
Okay.
22.5 minutes, or if you want to even go down to kind of like the 1 minute time frame, those within there. So you have quarter 3. So if everything aligns, that's where you're going to see the biggest expansion of volume for your potential runs, or for just your potential entries and plays. So like usually I kind of try to stick around quarter 3 of quarter 3 of quarter 3. And usually if you actually go back and then kind of do journaling and things like that, you'll start to kind of see the correlations of like, that's where you get the biggest expansion of price for that day.
So talking about quarters, and you have 4 quarters, would you even say that it would make more sense to even trade during quarter 3 instead of quarter 1 or quarter 2 as well?
You said what?
Would it make sense for you to say that it would be way more convenient to trade quarter 3, the overall quarters, right? You have 4 quarters, 1, 2, 3, and 4 within the entire year. Would it make sense for you just to trade during quarter 3 and that's it?
That'll be the most optimal time.